Hello, this is Mike Regan, and it's my pleasure to welcome you to another On the Record interview with our friend Gary Shilling. And Gary, with this interview, you have set the record for the person we have talked to the most. And the reason why we love talking to you is because you've got a sterling track record. For those of you that may not be familiar with Gary, his bio was too long to read, but suffice it to say, he's been on all sorts of talk shows and all sorts of publications, been recognized for his shrewd and insightful comments. I've been a long time reader of his newsletter that comes out each and every month. It's a fantastic publication. If you're interested, we can share with you how you can get it. And so, Gary, I'd like to welcome you, and let's get going and talk about what's going on with the economy.
Okay, Mike, let's go.
So, Gary, please help us understand all sorts of different opinions and views about what's going on in the economy and globally here in the United States, and anxious to get your views on helping us understand. You know, we run businesses, or for a lot of folks that are going to be listening to this and they're involved in the supply chain activities, give us your insights about where we're at today.
Well, we're in an interesting economy now. One of the most fascinating features is, of course, the Federal Reserve decisions to taper, to cut down their purchases of securities and then move on to raising interest rates. And they've speeded up that timeline considerably. And what's fascinating is this has been well known in the last year, and yet you would expect in this environment that there would be a big jump in interest rates. But if you look at Treasury bonds, they've actually rallied. Those rates are down 0.5% in the course of last year. And you say, what's going on here? Well, I think there are a number of factors that suggest that the economy is not going to be nearly as strong as a lot of people thought. One is the inventories. There was a lot of pre-buying of Christmas goods. Retailers encouraged people to buy ahead. They thought there'd be shortages, but they really have stocked up. They had more inventories. You look at Target, you look at Walmart, they had more inventories in their fourth quarters than they've ever had. And now we saw the Black Friday and Cyber Monday sales were disappointing. We're now seeing evidence of big returns, and it looks like we're going to get all these goods that have been waiting to get into the country from Asia. They will get delivered, and I think we got the makings of an inventory cycle. In other words, you have a situation where everybody is buying ahead, assuming that there's a shortages, and then suddenly the inventories arrive, and there's too much, and you got to cut orders, you got to production, get rid of them. That's one thing that's going on. Another one, of course, is we continue to have supply chain disruptions, but I think they are going to get ironed out. But if you look at the economy growth is really slowing. It's come down to 2 to 3% annual rate growth in real inflation-adjusted GDP. And one of the interesting things is if you look at consumers, the lower end of the spectrum, these people have spent the money they got from their stimulus checks back in 2020 and last year. They no longer have those extra unemployment benefits. The statistics show they show, for example, that credit card bills in May, 26.8% people were using credit cards to pay bills. It jumped to 33.9% in December. A lot of lower income people simply don't have the money to spend. Small business, you look at their sentiment index. It's down from 109 in August of 2018 to 98 in November. University of Michigan Consumer Sentiment Survey. It's down 15% from the end of 2020 to the end of 2021. So you do have evidence that the economy just is not showing a lot of strength, and a lot of people who had hoped that there was going to be this massive surge of spending of people from their stimulus checks. I mean, the surveys show that people saved 3/4 of that. They use that to increase their assets, to pay down their bills. They haven't spent it. I think a lot of people were really scared by the pandemic. They were caught short. They didn't have much money, and they realized that they've got to save. another thing that's going on here is the Omicron virus. If you look now, the weekly cases are up 100% since January of 2021. They're now about 500,000 per week, and that's twice the rate earlier. And you're getting school closings. A lot of businesses are delaying return to work. This drags on the economy. If you look at what's going on abroad, China is definitely slowing. They've had a big property bubble that the government doesn't like, and Xi, who's basically anointed himself as president for life, is tightening up on the economy. They're really trying to deal with the excesses in real estate and a lot of high growth sectors like private tutoring and these individual entrepreneurs. They're clamping down on that. They want more government control. So China is the second biggest economy in the world. It's 70% of U.S. GDP. And so if you get slowing in China, it has global effects. When you look at inflation, the interesting thing about inflation, yes, there has been a spur of inflation, but I continue to think it's been because of supply chain disruptions and reopening the economy. It hasn't been because of excess demand. And as a matter of fact, there is really no evidence that people have adapted inflationary expectations. Now, what I mean by that is when people, in effect, say prices are going up, I better buy now. It'll be too late because prices will go up later. And of course, it's a self-feeding cycle because then inventories are drawn down, capacity is strained, prices go up, suspicions confirmed, and people do the same thing. That's what happened in the late 60s and 70s. But you look, for example, you look, for example, at what's happening here. Inflationary expectations. New York Federal Reserve survey. People expect 6% inflation over the next year. Now that's very normal. The inflation expectations over the next year are almost always a duplicate of what's going on right now. The easiest forecast for everybody is just project the current situation. But then you look at, what do they say, 3 years, they go from 6% to 4%. University of Michigan, a very time-honored survey of consumers, they see 5-year inflation at 3%, and that's 2.8% was the average over the last 10 years. So there's no real evidence of that. You look at commodity prices. Commodity prices are down 10% off their peak if you look at Goldman Sachs Commodity Index. So I think you've got evidence that inflation is not picking up. Now, if we move on to central banks, this is what's really interesting because central banks are perennially behind the curve, and the Fed is not exempt. Their forecasting record is simply atrocious. I can go into chapter and verse if anybody wants to know the gory details, but it is really terrible. And they jib when they should jive. And right now, of course, they've finally gotten excited about inflation. They're tightening credit. But I think it's probably at a time when the economy was going to cool off, anyway. And but we are seeing that they're raising, they're going to raise rates. The Bank of England already has, other central banks, and of course some of these developing country central banks, they're forced to raise rates because otherwise, if the U.S. raises rates, it sucks money out of those economies, it sucks dollars out that they cannot afford to lose. So they are really forced to do that, and all this acts to cool things off. As they say, I think it's a mistake, but it is happening. Vulnerable stocks are unbelievably vulnerable, Mike. If you look at a measure that I particularly like, it's called the Cyclically Adjusted Price Earnings Ratio, developed by a good friend of mine, Bob Shiller, who was a PhD laureate from MIT. The bottom line is the stocks are now 57% higher than their long-term average in relation to profits over the last 10 years. He uses 10 years to iron out the cyclical fluctuations. And beyond that, they have been above that long-term average for most of the last 20 years. And if the long-term average still holds, and I think it does, we're going to spend a lot of time below that. In other words, stocks are really overblown. And then you look at what's going on in terms of speculation. You look at GameStop. You look at the cryptocurrencies. You look at things like the SPACs. There are 200 IPOs last year. 75% of them are selling below their initial price, and 40% are down 50%. One of my favorites here, I think everybody knows about is Robinhood. Robinhood went public on July 28th at $38 a share. It jumped to $70.39 in August 4th. Guess where it is now? $15.26. It has collapsed. You look at all these speculations, American AMC, Robinhood, cryptocurrencies, and what's interesting is that this is very normal. You've had all this money floating around created by the Fed, created by this fiscal stimulus, and it hasn't really gone into spending on goods and services. It's going into speculation. Some of it into housing, a lot of it into stocks, and it really, what's happening too, which is very interesting, is a narrowing of the focus of stocks. It reminds me very much. Some of our listeners may remember something called the Nifty 50, and this was back in the late 70s when the narrowness of focus got narrower and narrower and narrower. And as a matter of fact, I was very concerned at the time because you got down to the point that the only things that people wanted to buy were Polaroid, which is gimmick cameras, Disney, which is amusement parks, Winnebago, motorhomes, and McDonald's hamburgers. In other words, they were saying they were rejecting the guts of the economy. They wanted the frills and outward fringes. Well, we have the same thing now, where you've had to focus on these speculative stocks. And you look at some of these things, Peloton, some of these Xylo. I mean, these speculations. These are the outward flourishes, and they're the first to go. But I think they are not the last. So I think you've got a situation here where we're probably, as we look ahead, what are we going to see? I think we could see a weakness in the economy with this inventory problem I mentioned. We'll know that in the first half of the year. Stocks look like they're cruising for a bruising. I wouldn't be at all surprised to see between the height of stocks and the Federal Reserve action to see a major bear market in stocks. And of course, that ultimately works to the benefit of Treasury bonds because people, when they get scared and inflation fears fade, they go to Treasuries and the yields decline. And matter of fact, if the Treasury yields on the 30-year bond went from where they are now back to where they were at their low, and this was in the panic in early 2020, you could make 30% on long-term Treasury bonds. I think that's probably a lot better bet than stocks now, which I think are probably going to run into trouble.
Wow. Gary, you've given us a lot to unpack here.
Okay. Glad to do so.
So let me see if I can unwind some of this here. Last year when we did the forecast there, we were talking, the inflation expectations. I think you've raised some really interesting points. What you're basically saying, and I would suggest this is passing this along to those of us that run businesses, some very insightful things to consider. That if I'm summarizing this correctly, that the economy may be weaker than what the experts out there are portraying. Point number one.
I think that's definitely the case.
Okay. You and I before this have had an interesting dialogue about, the inflation and you're saying, so for those that heard, and have been questioning whether inflation is transitory, you're saying that the hyperinflation that some have predicted, you don't see that in the cards.
No, there's no evidence of that. Now, we have had a bulge of inflation. I mean, it's running 6-7% year-over-year rates. But again, what really is of concern, Mike, is when inflation gets embedded. When people expect inflation, they buy ahead. It's a self-fulfilling prophecy. And I mentioned that's what we had in the late 60s and the 1970s. And there's no evidence. And I cited those statistics of what surveys show, both professional investors and consumers. And people are looking at this as a transitory phenomenon.
Okay, that's really very good. Something for us all to consider. Let's talk about a couple of other issues there. Everyone's got their eye on the Fed and tapering. The articles I've read is that basically, to a certain extent, the Fed has really painted itself into a corner by, with their monetary policies. Thoughts on that view?
Yeah, I have a lot of trouble with the Fed. It used to be the Fed did not announce their intentions. As a matter of fact, you had a bunch of experts in Wall Street who would spend the wee hours of Wednesday night after the Fed released their weekly numbers trying to figure out what the Fed was doing. Well, then when 2008 came along and we saw all the undisclosed problems in business and so on, full disclosure became the order of the day. And these Fed officials, they're mere mortals. And so they figure, well, we better be in that game too. This is my view. And so they started announcing what their targets were, and they call that forward guidance. They were going to tell the markets, tell business, tell consumers, tell everybody what they were going to do. The only problem is that their forecasts of what they were going to do have been absolutely atrocious. I mean, they've been the worst forecasters, and these are forecasts of things. The federal funds rate, which is their policy rate that they control, that they control it. Nobody bucks the Fed on that. That's their number, and yet their ability to forecast what they were going to do has been atrocious. So I think the problem is that the Fed is really, as you say, they pointed themselves into a corner. They got stuck in this forward guidance deal. They really are in a position, and right now they've been telling the world in the last year that they were going to reduce their purchases of mortgage-backed securities and treasuries, and they're going to raise rates, use that as a prelude to raising rates. And I think now they're in a position where they're really are, to save face, they're forced into this, even though I think they're probably if they were looking at it afresh and didn't have this bogey out there, they probably just say, hey, we're going to wait. We're going to do nothing.
Okay. I've got, you've really raising some very insightful issues, comments there. Let's broaden this, and then I'm going to bring it back to something that, we're seeing in our Manufacturing Excellence Network, and get your thoughts on that. Globally, what are we looking at globally that could impact us here in the United States? You mentioned China. I'm curious about your thoughts on, Europe, the events. Are there black swan events that you have your eye on? For example, Lord, may it never be, things like China moving on Taiwan or Russia moving on the Ukraine. Walk us off the ledge there, Gary.
Well, walk us off the ledge. Okay. But give me plenty of rope to hang on to when I go down. Yeah, there are obviously the black swans. Russia could invade Ukraine. We could say we're going to take a stance in Ukraine. You've got Taiwan. You've got the minority groups in China, where the Chinese are roughing them up. You've got a lot of potential problems there. But when you try to narrow it down to what is more likely, I think to look around. I mentioned China. China growth rate is definitely slowing, and part of that is by design, simply because Xi, president for life, in effect, he wants more control. He does not want the private sector. When you go back to Mao, and then Jiang, who really he's the guy who said to get rich is glorious, and that opened things up. But they really look on capitalism as a transition to socialism, to communism. They do not look on that as a permanent solution. And so the control is very, very important to the Chinese. Historically, it has been. And so I think that's their number one objectives. And obviously, if you stifle the entrepreneurs, which is what they're doing, you're going to get slower growth. Now, bear in mind that a lot of people in the world, including the Chinese leaders, do not look on economic growth as necessarily the top objective. We tend to, but we're a little different than a lot of these areas where staying in power is the number one objective. And so you have this slowing in China. You look at Europe. Europe is really going nowhere. It's not falling apart. It's not growing. It's really pretty stable. I think if we want to look for hotspots, and I mentioned this earlier, it's these developing countries. It's all these countries that have borrowed a lot of dollars, and now they've got to service that. They've got to pay back the interest and the principal on those dollars, and their currencies are collapsing against the dollar. Well, that means it takes more of their local currencies to make those payments. And so that puts them in a real bind. So what do? Well, they raise interest rates. They try to make it less attractive for money to flee, try to keep it in there. But of course, that slows their economy. It's a self-fulfilling cycle. So I think that's an area that if we wake up one of these mornings and find out that it just isn't Turkey, and Turkey is a basket case. I don't know if you followed that at all, but we find that a lot of these other countries are in equally difficult conditions. That could be it. Now, that's not enough to sink the ship. These countries, they can be important as sources for imports in this country, for investments abroad. They're not big enough to, they're collectively only about 20% of the world economy. So they're not big enough to sink the ship. But they certainly can be disruptive to markets. And when you're talking about particularly global markets, very dependent on imports and transnational transactions, they are important.
Okay. We've got, when you were saying developing countries, you bring up a Turkey and some of the others that could potentially go. Let's bring it back here to the United States, if we might. Obviously, one of the things that, we had the first of the stimulus packages under the Biden administration, the 1.5 trillion. It appears that Build Back America plan is at least temporarily derailed. Your thoughts and concerns about other stimulus-oriented government activities that could potentially be affecting us.
Yeah, well, we had three big rounds of stimulus, as I mentioned earlier. One was the middle of 2020. The second one was in December of 2020, and the third one was in March of last year. Now, people saved about 3/4 of the money they got from that. They didn't spend it, and what most of it, I think, a lot of it went into real estate. Went into stocks. It didn't get into goods and services. But there's a big dichotomy. The people on the top are in fine shape. A lot of people on the bottom, I mentioned earlier, have been strained. Now, are we going to get more stimulus? Probably not, unless the economy really tanks. And then, yeah, hey, why not? That seems to be the order of the day now. When in doubt, pump more money out from Washington. But right now, I think there's a feeling that with the with the rise of inflation, that there's been enough. There's a realization this money has not really gotten the economy going, and so I rather suspect that we're not going to really have any further big rounds. As far as this Build Back America, that looks like it's pretty much dead on arrival. You've got a couple of Democratic senators who are opposed, and bear in mind, Mike, we've got this evenly split Congress now, and it takes the vice president's vote in the Senate to get anything done. So, so you really have a situation of nothing happening. We're also facing, of course, in the 2022 elections, and the odds are that the Republicans will gain. That usually happens in off-year elections. The party that's out of power makes gains, and all they need is one more seat in the Senate and a couple more seats in the House, and they'll have majorities. So I think there's going to be a big emphasis now on trying to play to the election. Democrats have moved away from this more money, Build Back America. They're more into voter rights and other of their favorite programs. But I don't think there's going to be much more happening. Say, unless the economy goes off the cliff, and then of course you probably could, because in the face of an election, a soft economy is almost a sure sign that we'll have more economic stimulus.
Okay. Talking to some of my fellow presidents and CEOs type thing, one of the comments, one of them asked me to make sure I brought this up to you here. One of the things that we're seeing is a significant increases across the board. For example, on the wage structure, where we've said like the fight for 15 is settled. You're not going to find people at $15 an hour in a lot of these markets. I think one of the things I'm taking away though from your comments here, Gary, is that demand isn't as strong as people portray it to be, which acts as a moderating influence on how prices get set. Is that a fairly accurate assessment?
Yeah, I think that's true, but you touch on a good point. As a matter of fact, we have a major article in our January newsletter, Insight, on wages, and there's no question that the pendulum is shifting from profits to wages, to labor compensation. They basically are mirror images of the total economic pie, and for the last 20 years, really up until the financial crisis, profits share of the pie was increasing, labor share was diminishing, but now labor share is increasing, and I think it probably will. There are a number of reasons for this. One is that you've had an awakening of labor now. People are saying, "Hey, wait a minute! I don't have to commute. I don't even have to leave my house." And you're seeing one of the interesting things you're seeing in the fast turnover areas like fast food and retailing. You've seen big wage increases, and that's where you get them first. Now you get into manufacturing where the turnover is much slower. I think we'll eventually get there, but we are seeing the pendulum shift toward wages. Now it isn't going to get. We're not going to get a wage price spiral, because what ultimately you have is a damper out there, is a basically huge productive surplus in Asia. They're big producers. They're very weak consumers. China, 38% of their GDP is consumer spending. Ours is 68, more than twice as much. So there's this so-called savings glut. And what happens if you've got more production, more saving, than you have spending? It's a deflationary force, and it puts a damper on wages, as long as we have a fairly open international situation. So there is a limit on this. But I don't think there's any question that we're going to see further shift toward labor. Unions are flexing their muscles. Of course, you see these settlements recently. You've seen it with Deere. You've seen Kellogg. You've seen these other wage settlements, and so I think that anybody has to really be braced for this. Now, what do you do for this? If you're in business, what do you do? Well, I think what you do is you cut costs, you promote productivity, and American business is so far doing a great job of that. If you look at the growth in the economy in inflation-adjusted terms since the bottom in the early 2009, since then it's up on balance about 5%. Then you look at the total payroll employment, it's down 5%. In other words, you've had a 10 percentage point gap opened up there. What's it mean? It means that people are being used more effectively. Yeah, there are labor shortages, but businesses, I think, are doing a fantastic job of making do with the labor they have, getting more efficient, and I think that's going to be a very, very important mission as we go ahead, because there's a lot of forces that are working in favor of labor, including the administration, by the way, including the administration.
I mean, this is, I think, personally, very, very insightful. It's for those that are listening in on this, that running businesses, running supply chains, etc. I hope you're kind of sensing directionally here, looking beyond. I guess where I'm headed with this comment here, Gary, is that I because of the press and everything else, and we all love dog bites man is not a story. Man bites dog is big news. But one of the things that I think what you're highlighting is to take the focus off of what we're seeing right now and expand our view of the horizon 6 months out, 9 months out, a year, 2 years out. And just a thought there, one of my friends owns several fast food stores, is a franchisee. And, he was mentioning this about 4 years ago. He said, when wages are $8, $9, $10, $11, we're not going to spend the money to automate. You get it to 15 and you're going to see McDonald's lead the way. And so I walked into a McDonald's in Wisconsin and there were 2 people in the McDonald's.
That's a
2
fact.
people working behind the counter.
Yeah.
And, they're making the food. I ordered everything on there. I had to have a credit card, and it got brought out. And I was thinking that McDonald's 5, 6, 7 years ago might have had 10, 12, 15 people. So, fast forward, you're talking about this 10-point gap. Okay. Help me understand, what does that mean for, the future workforce expectations? I'm thinking like the AT&T operators back in the 70s. There were 100,000 operators. Today, there's 2,000. What does that mean for us?
And they're all in India. It obviously, American business has the amazing ability for self-preservation. Why not? You want to make an honest buck, and you obviously want to rise to the occasion. And as you say, when labor's cheap, the trade-off for automation is not there. I mean, I've been in fast food places where I remember this a year ago, first time I realized I had to put my credit card in before I even got the order in. Everything was wrong with me. Nobody was going to take my order. and that's happening. And it's American business. Yeah, there is this talk about labor shortages, and there's no question that there are not enough people to fill the available openings. But that doesn't mean that business is simply sitting on their hands, and I think we're going to continue to see this. So what does this mean? This means that businesses that help others cut their costs are going to be very, very well rewarded in future years, in my view. I think that's going to be a primary area, whether this is automation, whether this is better logistics, whether you name it. But anything that helps to cut costs, I think, is going to be number one winner.
Oh, and not that this is a plug for us, but that's been our business for 37, 38 years, helping companies reduce their freight costs, improve their supply chains. And one of the things that I think we're finding out to be rather interesting is in the supply chain area, in our YPO group, if you would have told me 3 years ago I could get 25 YPOers to talk about supply chain or attend a class on supply chain, I would have said, that's being optimistic. We held 2 sessions in July. We had 450 people sign up.
Yeah.
And I think that's kind of created an awareness that is, this stuff is important. A couple of things as we kind of head towards the finish line here, Gary. Like I said before, for those that are saying, oh my gosh, we're drifting towards Venezuela, and this type of stuff, we give us a spark of optimism, a spark of hope, if you would.
Well, we got some problems here. We've got the re-entry problems with the virus. A lot of things are changing. People working at home, people much more independent, labor really flexing its muscles. We're going to see, I think, complete reorientation of supply chains. The just-in-time inventory systems have been discredited because if you can't get the stuff in time, you can't run the machines. So we're going to see a lot more domestic production, a lot more from nearby areas. Mexico, I think, is going to be a big winner in this whole process. But I think there is going to be a accommodation to this, and there's no question, Mike, we're going through a transition period. There were a lot of things that were sort of bottled up there. I mean, you look at the use of telecommunications. I mean, I used to make periodic calls once a quarter on our major economic consulting clients. These are people I've been working with for 20, 30 years, and we know each other well, but I always felt I better go so they know that I love them. Well, now with the virus, you say, hey, we don't need to do that. We just get on YouTube. I mean, it's really made some considerable changes, which I think are going to stick around. And we've written about this in our insight. I think we had a list of 10 major changes that we think are going to be with us. But it's really a question of adaptation. And I think that probably the most important thing people have to realize is that we're not going back to where we were. Now, it's never a complete revolution. It's evolutionary, I suppose, revolutionary. But I do think the adaptation to the kind of world we're in terms of labor's demand, supply chains, more production, domestic, et cetera. These are important things that I think anybody running a business ought to take into account.
Well, one area, and I wasn't going to ask about this, but I think it's kind of curious, and I'd welcome your insights on this. And for those of you, once again, Gary's mentioned the publication. I've been, I think, an 11-year subscriber, and love it. And I get some insights there that I don't get anywhere else. So we can pass along information about how you can subscribe to that. One of the things, Gary, that's come up is this issue of the Great Resignation. You're familiar with that, where people, we have a baby boomer generation now that is coming towards the finish line. We had a webcast in December that was almost had 600 people sign up. We had an interesting comment from one of the CEOs of a very large truckload carrier. They increased their driver pay substantially. And what they found out was that a higher percentage than they thought of their drivers were saying, well, I can make as much money as I used to working fewer hours. I'm going to choose the fewer hour option. So these drivers went from making, from 40 hours down to 35 hours, 30 hours. And can you just briefly touch on how that potentially affects economic
this is more
concerns?
what I talked about earlier, Mike. You've had a real shakeup in labor. I mean, for example, people commuting. In the last 10 years, the average length of commuting time has gone up 10%. Well, just a lot of people, they say, wait a minute, I never liked commuting anyway. If you're in a major metropolitan area, as I am in the New York area, boy, this really makes a difference. So I think it really has caused people to rethink their lifestyles. You've had the movement to smaller cities. People want to spend more time with their families. And you're right, they're trading off income for what they consider better quality of life, more remote living, less hassle. That was what's really has pushed and continues to push single family housing in smaller cities and rural areas, people moving out of very expensive small apartments. So, yeah, I think you have had all of this thing. Now, this doesn't mean that people are going to say, hey, wait a minute, I'm never going to work again, because people do need money. They do need to put food on the table. But I think there is going to be a trade-off. What's interesting, and we're very different than the Japanese in many ways, but the Japanese have had virtually no increase in their living standard for 20 years. Now, they have a very high living standard, and it's a very homogeneous population. And there's a very different philosophy. Every time I go to Japan, I come back feeling I understand less about how they think than I did the last time. But the one thing you can say is that however it works, that they are satisfied with a high but not necessarily growing living standard. And I think we're seeing changes of that in this country.
Wow. Okay. Before I let you go, one of the things we've also done, you kind of call it in March of 2020. I'll never forget that conversation with you. You talked about the stock market being a bit frothy. The Shiller indicator that you mentioned there, running 57% above the long-term average, et cetera. So I know there are going to be some people on this call that are going to be disappointed in me if they don't get your insights on where they should be putting their money here over the next year. This is what, you've got a great track record, Gary, and I've listened to you very carefully. So help us understand, do we own hard assets? My wife and I have some real estate. We pulled the real estate off the market up in Wisconsin because, We sold some stuff that was, 30% more than it was in 2020. But then we pulled it off, saying it's not bad to have hard assets in a inflationary area. The stock market, you mentioned the long-term treasuries and, the potential for a 30% gain. What do we do? Help me understand.
Well, those are things that I think, and we do manage money, as you know, Mike, and we have a lot of cash in our portfolios right now. I think stocks are way overvalued. The Fed is in there, which until they get through, I think bonds are going to increase in price, decline in yields, but they're getting hurt at the moment. But there are other areas. One area that I'm personally involved in are upscale rental apartments in major growth areas, where I think that's part of the change in the lifestyle, where people are saying they'd like to be in away from major cities, but in urban areas, and they're not interested in single family home ownership. But there are many opportunities out there. I think that's one that I happen to be personally involved in.
Okay, so are there other things commodities? Are you expecting moderation?
Commodities, yeah, commodities. Commodities. If you look at Goldman Sachs Commodity Index, it's down 10% from its peak, and commodities are very much a forerunner of what happens in the economy. When you see, that's one of the things I think to notice when you look at the economy. When you see weakness in commodity prices, you usually can figure that there's going to be following weakness in the economy, and unless the economy is going to turn around and boil, I think commodity prices are probably going to continue to weaken. Oil, of course, is always tricky because it depends on what's OPEC and now OPEC plus Russia, et cetera, what they're going to do. But I don't think unless you're really looking for a rip-roaring economy, I don't think that commodities are a very good investment. I'd rather be short than long commodities.
Okay, one thing as we wrap it up, let me just throw an idea out at you and get your insights. One of the things that we were talking about in one of the business groups that I'm part of is what I call the benefits of scarcity. And what we have found out, what the ocean carriers have done this past 2 years, Gary, is by using blank sailings, canceling, and this type of thing, they've been able to see their rates for containers go up, 200 to 300%. Yeah. The automotive companies, I serve on the board of a publicly traded company. It had a lot of automotive customers. We were taking a look at, a SARS build rate going into 2021 of 19 million. It'll come in actually under 13 million. And yet I talked to a friend of mine that owns a car dealership. They've never made more money. They're selling their cars at above sticker price and this type of thing. Is that something, looking out over the 12, 24, 36 months, that we're going to see more companies say by restricting supply, we can charge higher prices?
I'd say take the money and run. I think we're in a very short-term bulge here, where you have that. I mean, for example, you talk about the automobile industries. We all know the big holdup there has been shortage of computer chips. Now, you've got a lot of cars partially finished sitting around, and as they get chip production ramped up and put in those cars, you're going to have a hell of a lot of cars out there for sale. So I think it's a situation, if you're in a situation like that, boy, I would take the money and run.
Okay. Well, maybe that's a great way to end it. Any other thoughts? Did I miss anything?
I think we've covered the universe here, Mike. And I'm glad to be with you,
Gary. And for those that don't know this, Gary is also sends out honey. And another reason why you got to be, you may not be able to visit him in person and show the love, but when I get those 2 honey bottles each year, I know that the Shilling love, you're sharing the love in a big way. So,
oh yeah, we got those bees working for all our clients.
Gary, thanks so much for the time. Look forward to continuing the dialogue.
Okay, Mike, thank you.